Hey, well, thanks for joining me with this video. I'm going to be talking about how to maintain your loans with an S corporation. If you've elected S and you want to keep that status, you have to maintain the qualification criteria of being an S corporation on every day of the tax year. And one of the key issues that garners the most attention is the one class of stock rule. This criteria of one class of stock is about distribution rights. All owners have to have pro rata rights to distribution and liquidation proceeds based on their percentage of equity ownership. So for example, if you own 51% of the equity, you should be receiving 51% of the distributions. A traditional C corporation tax problem would threaten your one class of stock status if it were not for what's called the S corporation straight debt safe harbor. One of the long-standing tax schemes has been to disguise equity as debt so that distributions to equity holders could be treated as debt repayments and therefore deductible interest expenses. Federal tax law gives the IRS tools to challenge this kind of capital structure by allowing them to re-characterize debt as equity if the features of that debt are not commercially viable. The statutory guidance is not historically been conclusive on how exactly or how you would know for sure that debt was really equity, but it provides a list of factors that would indicate debt is really like equity. For example, the statute talks about thin capitalization, where a large amount of debt in ratio to little equity is in the capital structure. That's one factor in determining the true economic character of debt versus equity in a company. While recharacterizing debt to equity can be an annoyance in the C corporation world because of the loss of interest deductions and the owner's recognition of dividend income, it would be devastating in the S corporation context. If the debt of an S corporation is recharacterized by the IRS to equity based on their analysis of the facts and situation, then that would result in a second class of equity and the termination of the S election. Consider the payments on that debt made, which aren't necessarily pro rata to their ownership percentages. That would be providing preferential distributions on that debt that's now recharacterized as equity, and that's why the IRS would be able to claim that it was a second class of stock. Fortunately, federal tax law provides us with the straight debt safe harbor for S corporations. That's to protect S corporations, their owners, from this problem. If the debt meets the criteria of the straight debt safe harbor, then the IRS cannot assert that it's equity under the before mentioned traditional tax rules. I'm not going to walk through all the criteria of the straight debt safe harbor, but there's four main criteria, and they speak to whether the debt is treated like regular commercial debt. One of the more interesting criteria of having debt fall under this straight debt safe harbor is that the lender is somebody that otherwise would qualify as an S corporation shareholder. This safe harbor, if you need it, look it up. Find out what those four criteria are to consider, or ask your advisor about it. But it's a powerful tool because it allows us to deal with what otherwise would feel like just a subjective analysis by the IRS, and it gives us some assurance that if we're meeting the criteria, that our debt cannot be treated as equity. There are other safe harbors that may eliminate the need to even meet the above that criteria for the straight debt safe harbor. For example, if a company has a temporary unwritten advance of less than $10,000, that happens. You advance the owner some money and employee some money, in this case the owner some money less than $10,000, and you treat that as debt on the books, the IRS won't try to recharacterize that as equity. Also, if the owners loan the company amounts that are proportional to their ownership, that proportional debt will not create a second class of stock. So even if the IRS wants to treat it as equity instead of debt, it's not going to violate the S election. The amounts loaned to an S corporation by a 100% owner of the company, therefore, could never be a second class of stock. Because think about that. If an owner owns 100% of the stock of the company and they also make a loan to the company, and the IRS comes in and says, we don't think that's a loan, it's actually just equity. Okay, the IRS does that, but it doesn't change anything because there was only one owner to begin with. So there's not a second category of ownership or a second category of owner getting different rights to distributions. So the straight debt safe harbor is relevant when you have multiple owners in an S corporation and there are loans to the business that are not proportional to the ownership. When that happens, it's advisable to ensure that your debt agreements comply with the straight debt safe harbor. Well, that's it. I'm going to get back to gardening. See you all later. Bye now.